Welcome back. The topic for the day is transfer pricing. So what exactly is transfer price? Transfer price is the price at which one division transfers goods to another division within the same company. So you might wonder, what's the big deal? After all, it's the same company and it's only an internal transfer that's taking place. So why the hassle of studying transfer pricing? The reason is simple. This is to avoid the suboptimal behavior on the part of the divisional managers. Now, what exactly is the suboptimal behavior? I will give you an example. Suppose I am the manager of Division A and you are the manager of Division B. I manufacture a component which is required by your division. Suppose the cost of making the component is $5 for me, and the same component can be purchased from the outside market at $7. So from whom will you buy? You will definitely buy from me at $5 because that is cheaper. But because I have a target profit and my bonus and incentives are based on this target profit, I will not sell it at cost price. I will tell you that I am willing to sell the component to your division at $8. That is, 5 is the cost and I want to make $3 per unit as profit. So what will you say? From the outside market, you can get it $7. So why should I buy from you at $8? Correct? That is what you're going to say. So you will immediately say you can keep your product for yourself. I will buy from the outside market at $7. Now we will think about the company's case. As far as the company is concerned, what is the cost of the component? The cost of the component is just $5. And at what rate did you buy from the market? You bought from the market at $7. That is an extra $2 for each component that you bought. And who's bearing the loss? The company, of course. This is known as the suboptimal behavior of the divisional managers. So to prevent that, we need to find out what is the best transfer price so that the company profits will not be adversely affected. So what could be the objectives of transfer pricing? The first objective is goal congruence. It means that the division and the company should have the same goal. And what is the goal? The company profit maximization, not the individual profit maximization, but the profit maximization for the company as a whole. And avoid suboptimal behavior. And when do we have suboptimal behavior? When the divisional decisions are not in the interest of the company. That is, it will always be for the self-interest of the divisional manager and not suited to the company interest. Now, the next objective is performance measurement, fair assessment of the buying and selling division. Now, we know that the bonus and the incentives of the divisional manager are based on the profit of their division. So which means that the transfer price should always assess them on a fair basis or they will be demotivated. And the third objective is autonomy. More autonomy should be given to the divisional managers. What do you mean by autonomy? It means the ability to take decision on your own without being controlled by the head office. So if the rules of transfer pricing have been set properly, they can definitely take decision on their own without being controlled by the head office. And the last objective is recording. It is to record the movement of goods. Whenever goods are transferred from one division to another, it is very essential that a recording has to be done in the books of accounts. So at what price will you record? So for that purpose, transfer price is essential. Now today, I will take you to a company to understand the concepts of the transfer pricing better. The company is called Toyland. So let's go there and understand their business first. So we have reached the company. Now the company has got two divisions. One is Division A and the second one is Division B. Division B makes toy cars and Division A makes fancy boxes for packing these toy cars, which means that the product of Division A is required by Division B. That is, Division A is the selling division and Division B is the buying division. Now let's go inside and meet the divisional managers. I am Jane, manager of Division A.
I am Gabby, manager of Division B.
I can sell the boxes in the market or transfer to division B. Now, the first method of fixing the transfer price is the cost-based approach, in which we take the full cost of the product. So let's ask Jane the cost details of the product. Here are the details of division A. Okay, so since we have got the details of the product, we will start off with the first method of transfer pricing, the cost-based approach, in which the full cost of the product is taken. In this method, the transfer price is equal to the full cost plus a markup percentage. So first we will see what is the full cost for making the product. So here we have the selling expenses per unit. This is to be completely ignored. Why? Because when we are making an internal transfer from division A to division B, we do not incur any selling expenses. Selling expenses are incurred only when we sell the product to the outside market. Basically, for any kind of transfer pricing decisions, we do not need to consider the selling expenses simply because selling expenses are not incurred while transferring the product from one division to another. So selling expenses we are ignoring. What is the next expense? Okay, so there is variable expense, which is excluding the selling expenses. That has to be taken $2. Fixed cost total is $1,000, and we have a production capacity of 1,000 units, which means that the fixed cost per unit works out to $1. So what is the total cost of the product? $2 is a variable cost, excluding the selling expense, plus fixed cost works out to $1. So the total cost is 2 plus 1 or $3. So we got the full cost. Now, the markup percentage will be fixed by the head office, and say the markup is 10%. So what is the transfer price? Transfer price is variable cost excluding the selling expenses. I have indicated variable cost excluding the selling expenses with VCE, E standing for excluding. Okay. So it is variable cost excluding the selling expenses plus the fixed cost. We know that variable cost excluding selling expenses is $2 and fixed cost per unit is $1. So the total cost is 2 plus 1, $3 into 110%. Why 110%? Because the markup is 10%. So the transfer price is 3.3. So division A's total cost is $3, and when it transfers to division B, it transfers at 3.3, making a profit of 10%. So that's the meaning of the full cost approach. Now, in this case, the variable cost and the fixed cost are the standard costs which are taken and not the actual cost. Why is that so? Now, whenever we are taking the variable cost and the fixed cost, it is the standard cost which are to be taken and not the actual cost. Because if the standard cost is, say, $3, okay, and Jane is very careless and she spends, say, $4. So the actual cost works out to $4. Now, if we were to take $4 as the basis for calculating the transfer price, then this extra expenditure incurred because of Jane's carelessness gets passed on to division B. We don't want that. We want Jane herself to suffer because of her carelessness. So it is advisable to calculate the transfer prices based on standard cost and not on actual cost. Now moving on to the second method, that is the marginal or the variable cost approach. In this method, we take the transfer price as only the variable cost plus the markup percentage. So what is a variable cost? Variable cost is $2, and definitely we never consider selling expenses because they are not incurred while we make an internal transfer. So if the markup percentage is, say, 10%, then the transfer price is equal to variable cost excluding selling expenses into 110%. We have the variable cost excluding selling expenses at $2. So it's 2 into 110% or $2.2. Now moving on to the third method, that is the opportunity cost approach. Now the full cost approach and the marginal cost approach are not that important, because it is quite simple and we cannot expect simple questions for the ACCA exams, right? So even if you were sleeping till now, it is fine. But for the next method, please be very alert because it's important. So the third method is the opportunity cost approach. Here we try to find out what is the minimum transfer price that is acceptable when goods are transferred from division A to division B. Now, there could be three situations. The first situation is there is no spare capacity. What do you mean by there is no spare capacity? It simply means that division A is able to sell its entire produce in the external market. So let's get to the details. So there is a whole lot of details which are given. First is the production capacity. The production capacity of division A is 1000 units. That is a maximum number of units that A can produce. And what is the spare capacity? The spare capacity is 0, which means that the demand in the external market is also 1000 units. That is the reason why spare capacity is 0. Now, selling price in the external market is $4 per unit. Selling expenses per unit is $0.5 per unit. And variable cost excluding selling expenses is $2. And fixed cost, we have it at $1 per unit. So what is the minimum transfer price in this situation? Now, think for yourself. If A sells the goods in the external market, then what is the amount that they are getting? They will get $4 per unit less the selling expenses, which means that they will get $3.5 per unit if they sell in the open market. Now, if they transfer these goods to division B, then it is logical on the part of the divisional manager to ask for an amount of $3.5 from division B, because that is the amount that they will get if they sell in the open market. So why should the divisional manager suffer just because she's making a transfer to division B? So the amount that she should demand is $3.5 per unit, which will be the minimum transfer price. So the minimum transfer price is selling price minus selling expenses per unit. That's the net amount that she gets if she sells in the open market. So it is $4, which is the selling price, minus 0.5, which is the selling expenses per unit. So it is 4 minus 0.5, or $3.5 per unit is the minimum transfer price.
Now, in this method, you might wonder, why is it called the opportunity cost approach? What do you mean by opportunity cost? Opportunity cost is the revenue which is lost from the next best alternative. So if the goods are transferred from division A to division B, what is the lost contribution? So let's calculate the contribution that division A would receive if it sells in the external market, because that's the contribution that A will lose if it transfers to division B. Contribution, as you know, is selling price minus variable cost. So we have the selling price at $4, and the variable cost, it's divided into two parts. One is the selling expenses per unit, and the other one is a variable cost per unit. So the lost contribution or the opportunity cost will be 4 minus 0.5 minus $2. So that's what I've written here, which is equal to $1.5 per unit. So the alternative formula for calculating the minimum transfer price is variable cost excluding the selling expenses plus the opportunity cost. I have written variable cost excluding selling expenses with a VCE, E standing for excluding selling expenses. Okay, so the loss contribution, we know it is 1.5. Variable cost excluding selling expenses, we know it is $2. So what is the minimum transfer price? It's 2 plus 1.5, or $3.5 per unit. So we get the very same answer if we adopt the second formula also. But you need to remember only one formula. Whenever there is no spare capacity and they ask you to adopt the opportunity cost approach, the formula for calculating the minimum transfer price is selling price minus selling expenses per unit. Now, this method is also known as the market-based approach, simply because they are considering the selling price for arriving at the minimum transfer price. So you adopt the very same method if the question asks to calculate the minimum transfer price according to the opportunity cost approach, and you notice that there is no spare capacity, or the question asks you to calculate the minimum transfer price according to the market-based approach. For both these, you have to apply the formula selling price minus selling expenses per unit. Now moving to situation 2. Situation 2 is you have spare capacity, but this spare capacity do not have any alternative use. So in this case, what is the minimum transfer price? Please note that out of the production capacity of 1000 units, we have a spare capacity of 200 units, which means that we will be able to sell only 800 units in the external market. So the minimum transfer price has to be calculated for 800 units in one way and 200 units, which is the spare capacity, in a different way. So first we will calculate for the 800 units, that is where there is external demand. So what do? We adopt the very same formula that we studied in situation 1. So for 800 units, it is selling price minus selling expenses per unit. Selling price, we know it is $4, and selling expenses per unit, we know it is 0.5. So it is 4 minus 0.5 or $3.5 per unit. So that is regarding the production which has an external market. Or what was the alternative formula? It's variable cost excluding the selling expenses plus the opportunity cost. And we know that the lost contribution or opportunity cost is $1.5 and variable expenses excluding selling expenses is $2. So it's 2 plus 1.5 or $3.5. This is what you studied in the previous situation. Now listen carefully. For the 200 units of spare capacity, we can adopt the very same formula, variable cost plus opportunity cost. But here, where there is spare capacity, do we have any lost contribution? We had no plans of selling it in the market simply because there was no demand. So opportunity cost in this case is 0, which means that we have to just take the variable cost excluding the selling expenses whenever there is spare capacity. So variable cost excluding selling expenses is $2 per unit, and opportunity cost of the lost contribution in case of spare capacity is 0. So it's 2 plus 0 or $2 per unit is the minimum transfer price as far as the 200 units of spare capacity is concerned. So whenever there is spare capacity, all you have to take is the variable cost excluding the selling expenses. Now moving to situation 3. Situation 3 is spare capacity. You do have spare capacity, but this spare capacity has got an alternative use. What do you mean by alternative use? Alternative use is if you are not able to sell in the market, then maybe you could sell it to the employees at a reduced price. So that is an alternative use of the product, right? So in this case, what do? For 800 units, it's the very same thing. That is the quantity that we are able to sell in the market. So it's just selling prices minus selling expenses per unit. So we copy the very same thing that we did in the previous situation. There is absolutely no change for the 800 units. Now regarding the 200 units of spare capacity, which has an alternative use. So what is the formula? The formula is variable cost excluding selling expenses plus opportunity cost. So here, what is the additional information? Spare capacity has an opportunity cost of $0.5 per unit. So all that we have to do is, in place of opportunity cost, just key in 0.5 per unit. So variable cost excluding selling expenses will be $2 per unit. So it's 2 plus 0.5, which is $2.5 per unit. So whenever you have a spare capacity with alternative use, you adopt the very same formula. It's variable cost excluding selling expenses plus the opportunity cost. Opportunity cost will definitely be given in the question for that alternative use. Now, what we just calculated is the minimum transfer price of the selling division. Now we will go to the buying division, that is division B, and calculate what is the maximum transfer price that they will accept.
Now here we are with the manager of division B. He says, I can buy boxes from the market or can transfer from division A. So he's got two options. What is our aim? Our aim is to find out what is the maximum transfer price. So let's get to the details. So the selling price of division B's product is $10 per unit and own variable cost. What do you mean by own variable cost? The variable cost incurred by division B alone. That amounts to $2 per unit. So it is stated that it excludes the components cost which could be transferred from division A. Now, fixed cost per unit is $1 per unit and the external purchase price is $8.5 per unit. Now think for yourself, if you are the manager of Division B, what are the two things that you will consider? One is you don't want to end up in a loss, correct? By buying this component. And the second one is you will look whether there is a cheaper component available in the market. These are the two things that you will consider, right? So we have to find out the transfer price of the component so that we do not end up in a loss. So right now, that is without considering the transfer price, what is the profit? Selling price is 10 and we will reduce all the expenses. So minus own variable cost 2 minus fixed cost 1. So 10 minus 2 minus 1, the current profit is $7 per unit. So in order to have that no profit, no loss, the maximum transfer price that Division B can pay is $7. So when $7 comes here, we will end up with a profit of $0. So that is a maximum transfer price that Division B can afford to pay. Now there is a small twist. Should we consider the fixed cost in all the situations? Fixed costs need to be considered only if we are below the break-even point. If we are above the break-even point, what is the peculiarity? The fixed cost has already been covered. So we don't need to consider fixed cost in such kind of situations. So we don't need to consider fixed cost for calculating the maximum transfer price. So without considering the fixed cost, what will be the maximum transfer price that we can take? So it is 10 minus 2, which means that it is $8. So assume that fixed cost has already been recovered by this division. So fixed cost will not be there. So it's 10 minus 2 minus 8. We are ending up with a profit of $0. So this is the way in which you have to calculate the transfer price. So the two items that we will be considering is the selling price minus the own variable cost. And selling price minus own variable cost is nothing but the marginal revenue. So we will consider the marginal revenue. And what is the second thing that we will consider? We will consider whether it is cheaper to buy from the external market. In this case, marginal revenue is $8, that is 10 minus 2, and the external purchase price is 8.5. So it is not cheaper to buy from the external market. So the maximum transfer price will be $8. So as a formula, if you have to remember, the maximum transfer price is lower of the marginal revenue, excluding the purchase price of the component that you're transferring, which is calculated by selling price minus own variable cost. In this particular case, it is 10 minus 2 or $8. And then you compare it with the external purchase price. In this case, it is $8.5. Whichever is lower, you will select that. So in this case, $8 is lower. So we will select $8 as the maximum transfer price. Now you might wonder, there might be companies where fixed cost has to be considered. Agreed. But this is just the maximum transfer price. It is not the final transfer price. So you're just establishing a range in which we can make negotiations. So that is why fixed cost is completely ignored. Now we know that the maximum transfer price is $8 per unit as far as Division B is concerned. Now what was the minimum transfer price as far as Division A was concerned? It was $3.5 per unit. This is what we calculated. That is when there was no spare capacity. So what is the range? So I've just copied those figures. Minimum transfer price is $3.5 and the maximum transfer price from Division A is $8. So the final summary is the transfer price should be between $3.5 and $8. So always remember that the minimum and the transfer price will always be calculated, and then the divisional managers will negotiate among themselves, and then they will fix the final transfer price. Now, from the selling division's perspective, that is from the perspective of Division A, the minimum transfer price is, in case of the full cost approach, it is full cost plus the markup percentage. In case of marginal cost or the variable cost approach, it is the variable cost plus the markup percentage. And in case of the opportunity cost approach, for situation 1, that is where there is no spare capacity, it is selling price minus selling expenses per unit, also known as the market-based approach.
In situation 2, where there is spare capacity without alternative use, it is variable cost excluding selling expenses. And in situation 3, where there is spare capacity with alternative use, it is variable cost excluding selling expenses plus the opportunity cost. Now coming to the buying division's perspective, that is division B. The maximum transfer price is the lower of the marginal revenue excluding the transfer price, that is the selling price minus the own variable cost and the external purchase price.
So we are finally done with transfer pricing. We will be taking up the questions from the exam kit in the next session. So thank you for watching and see you in the next video.